So I hear it all the time from people who are afraid to invest in the stock market, have never done it, or have only heard horror stories about people investing in the stock market. Isn't investing like gambling? And the answer is absolutely not. Not when you do it correctly. And in today's video, I'm going to be explaining the difference between investing and gambling. And I'm going to tell you why it is so important to actually invest your money. So, the biggest difference between investing and gambling is the expected outcome. If you go into a casino and you gamble every single day for a year, what do you expect? You expect all your money to go away. If you are investing, if you can consistently invest across the entire year, you expect more money. And this same logic applies across 5, 10, 20, 30-year timeframes. You might be able to win at gambling for a year, 2 years, 3 years, but across a 10, 20, 30-year time frame, the expected outcome is that you're going to lose all your money. But if you're investing, the odds are in your favor. Across the 10, 20, 30-year time horizon, you expect to make a significant amount of money. And this is the biggest difference between investing and gambling. And I hear it all the time, but I don't want to take that risk. So, what people do is they keep their money in very conservative investments, either cash or bonds, and they avoid the stock market. But that is not the way to think about this because there's a huge difference in the expected returns from holding cash, bonds, and the stock market. So if you hold cash, you're expecting maybe about 2% returns. And if you're holding bonds, you're expecting about 4% returns. And if you are holding stock, you're expecting 8% returns. So what that means is you have to save 4 times as much money in cash to equal what you would have had to save in stock. And if you are saving with bonds, you need to save 2 times as much in bonds to equal what you would have had to save in the stock market. And to drive this home, think about it as a percentage of your income. If it's just cash, to get the same outcome as holding stock, you need to save 40% of your income. And if it's just bonds to get the same result as just stock, you need to save 20% of your income. Where with the stock, you could have saved 10% of your income and gotten the same result. This is a huge difference in savings rate. The difference between saving 40% of your income and 10% of your income is massive. So, this is why it is so important to put your money to work in the stock market. And that 8% return is actually a pretty conservative number. So, on average, since the inception of the S&P 500, it makes 10%. You have some years where it significantly outperforms that, and some years where it's negative. But if you average out these returns across long time horizons, 10, 20, 30 years, you expect to get about 10%. And then you take into account a 2% inflation rate, your real adjusted return is about 8%. This is a solid assumption. And if you can lock that in, you're going to have phenomenal results. The other mistake that people make is over indexing on current events. You are saturated with news and articles talking about market downturns and market volatility and AI bubbles. And All of this news is focused on right now. It's not telling you what you should be expecting from your accounts 10, 20, 30 years from now. They're focused in on this quarter of earnings, this week, this month. Those are very different games that these people are playing. The analogy I like to use is smoking a brisket.
What? Bro, what are you talking about, man?
So, yes, I live in Texas and I've learned way more about smoking a brisket than I ever used to know when I lived on the East Coast. But stick with me. The best way to smoke a brisket is low and slow. You get it on a low heat and you cook it for an hour to an hour and a half per pound. So, with a standard brisket, you're talking about 10 to 16 hours of cooking, right? And what they like to say is if you keep peeking at that brisket, if you're looking, you're not cooking. So you don't want to keep looking at the brisket. You got to let it cook. And the same thing applies to your retirement portfolio. You don't want to keep looking at your retirement portfolio, messing with your portfolio allocations, hopping in and out of cash and buying back into the market. Because if you're looking, you're not cooking. You got to leave these things alone and let them do their work. The other big mistake that I see people taking is they're not taking enough risk with their investments. So they invest in the stock market, but they are not invested in a straight S&P 500 index fund. They're invested in some sort of income generating dividend ETF, and they think, oh, I'm generating money from my stock holdings. This is great. This is perfect. But the expected returns of these blue chip, high dividend companies is less than the overall mix of the S&P 500. You want to assume the full market risk across long time horizons because you are going to get the best result. And this happens even as you approach retirement. People reallocate into a more conservative stock bond mix, and they have 10, 15, sometimes even up to 20 years before they hit traditional retirement age. And when you're working with timelines that are that long, you do not have to start hedging risk in your portfolio yet. You can stay 100% allocated into stocks and get the full market participation across that time frame. If you aren't getting that full market participation and you are in a heavily bond focused or heavily cash focused portfolio, you're actually introducing inflation risk. The portfolio growth could be getting outpaced by the inflation of prices in the market. So your real spending ability of your money you're saving could go down over time because you're not invested aggressively enough. And this is a real concern when we're talking about 20 and 30-year time horizons for investing. And then the other extreme is to overly aggressively invest. This would be investing in a single stock, investing in a single theme or a single sector of the market. At this point, you are concentrated in a single thing that could tank your returns. This is called idiosyncratic risk. When you are heavily concentrated into a single company or single stock or idea, and you want to avoid this at all costs. So an index, a bundle of stocks, they will revert to the mean. If the market is going down, the next most likely outcome is for the market to go up. And if the market's going up, the next most likely outcome is for it to go back down to that mean. You expect it to hover around that 10% return level. But an individual stock, an individual company, there are no such guarantees. Stocks can go to zero and never recover. And you do not want to be exposed to that kind of risk. Another example of taking the wrong kind of risk is people who decide they're going to start day trading or swing trading or options trading. This is gambling. It is possible to gamble in the stock market. And this is it. Because the long-term expected outcome of these activities is that your money goes to zero. So there was a stock trader named Captain Condor, and he was trading options. He developed a large following, a community of people who were trading options with him. And he was trading very volatile, zero-day options. So December of last year, a week before Christmas hits, Captain Condor and his followers ended up losing $50 million in a single week. That's right, $50 million. So he had been successfully trading since 2022 all the way until 2025. His strategy had not failed. He had worked consistently. He had generated all this money for his followers. And then in December of 2025, they were wiped out. They lost everything. And it's because they were gambling. There's no guarantees when you are making these active bets in the market over and over and over again. The only thing that is consistent and guaranteed is that over long time horizons, we expect a better outcome if you just buy the index and wait. And unfortunately, 2026 is the sixth consecutive year where they expect options trading in the US to increase. People keep making these speculative bets in the stock market. And that's not what you want to be doing with your money. You want to diversify and you want to hold on for the long term. And if today's video made it clear why you need to invest instead of gamble, and why it is important to not just save your money, but invest your money, like the video, share it with somebody else, because I'm trying to make you 1% better every day. Thanks for tuning in, and I'll catch you in the next video.
Stay in the market, keep your vision on the prize, building up the wealth right in front of your eyes. Talk Higgins, yeah, we keep it moving. Talk Higgins, watch the wealth improving. Markets and the money making sense of the math, helping you navigate the financial path. Talk Higgins, subscribe for the vision. Stay smart, stay invested. We out.